Hey everyone, today I'm going to show you how to identify market bottoms, not by gut feeling, but by reading a clear chain of evidence that the market leaves behind every single time. After this video, you'll know exactly when to wait, when to act, and when to walk away. Here's what most people don't realize. A bottom isn't a single candle. It's not one signal that suddenly tells you this is it. A real bottom is a sequence, a series of behaviors that stack up, one after another, until the picture becomes undeniable. And at the end of this video, I'll put it all together for you, so you can apply this in your very next trading session. But first, we need to go through it, step by step. So let's start with the big picture. Before we dive into the details, I want you to see the full picture first. There are several well-known approaches to reading market structure. Wyckoff, smart money concepts, price action. They use different terminology, but they all describe the same underlying behavior. When you understand what's actually happening beneath the surface, the labels stop mattering. And here's the sequence. Many of the best bottoms, the ones that lead to sustained rallies, follow a recognizable path. First, selling exhausts itself. The market stops falling, not because buyers show up in force, but because sellers run out of steam. Then comes a retest. The market dips back toward the lows, and this is the step most traders misread completely. We'll come back to it. After the retest, if the market passes, you see a structural shift. Price breaks the downtrend from the inside. And only then do you look for your entry. Volume ties all of this together. It's the thread running through every stage, telling you whether what you're seeing is real. So think of it as a chain. Exhaustion, a test, structure shift, entry, all confirmed by volume. Break any link in the chain, and the setup falls apart. Now, one important thing. This sequence works on any time frame, daily, 4-hour, even 15-minute charts. But the higher the time frame, the more reliable the pattern becomes. A signal on a daily chart carries more weight than one on a 5-minute chart. The way experienced traders use this, the higher time frame tells you whether you're in a bottoming zone, the lower time frame gives you the entry precision. Keep that in mind as we go through each step. Let's start building this chain from the first link. The process starts the same way. The downtrend begins to lose momentum. Here's what that actually looks like. At some point during the drop, something subtle changes. The selling is still heavy, big volume, wide candles, but the price stops making meaningful new lows. It's like throwing punches at a wall. All that force, and the wall barely moves. That's absorption. Someone is buying everything the panic is selling. The volume is massive, but price goes nowhere. And that mismatch, heavy effort, tiny result, is your first clue that something is shifting underneath. And if you think about it, this makes perfect sense. Large players, funds, institutions can't build positions in quiet markets. If they buy aggressively when volume is thin, they push price up against themselves. But during panic, there's more than enough selling volume to absorb their buying without moving price. Panic is the only environment where institutional size can get filled. So every time you see heavy selling with no price progress, that's not weakness, that's opportunity being taken. Then something natural happens. With the sellers spent, price bounces. Not because buyers suddenly show up in force, but because there's simply no one left selling. Like lifting your hand off a ball underwater, it floats up because the force holding it down is gone. But here's the real question. Was that the bottom, or just a pause? The market answers this by coming back to test the same area. And this retest isn't random. Traders naturally anchor to previous levels. So the question the market is really asking is, can the sellers push it down again? When the retest happens on noticeably less volume, with smaller candles and less conviction, the answer is no. The sellers tried again and barely showed up. That contrast, heavy selling the first time versus weak selling on the retest, is your first real confirmation. After this, the market often drifts sideways for a while. Volume contracts, the range tightens. This looks boring, but it's important. The absorbing side can't buy too fast without pushing price up, so they accumulate gradually, trade by trade. That's why this phase takes time. A lot of people mistake bounces during this sideways phase for the bottom and get caught when price drops again. Now, not every bottom features the dramatic event that comes next. Sometimes price just forms a higher low and breaks out directly. But the most common version, and the most recognizable, involves one final test, and that test is the part that separates catching a bottom from getting caught in one. This is the heart of the whole sequence, the final trap. After the market has built its base, the absorption, the sideways range, there's one event that resolves everything. Price breaks below the established floor and then quickly snaps back into the range. It looks like a breakdown. It feels like the downtrend is resuming, but it's not. It's a trap. Stops get triggered, late sellers pile in, and then the market reverses, leaving them stuck on the wrong side. This is the most important event in the entire bottoming process. Now here's what separates a high-quality trap from a dangerous one. It comes down to one question: how much real selling showed up on the break? If price dips below the floor and the volume is low, quiet, almost uneventful, that's actually the best sign. It means there's almost no supply left. The sellers are gone. You can act on this with confidence. If the break comes with moderate volume, it's still a valid trap, but you'd want to wait for a quiet retest afterward. One more calm revisit that confirms the sellers are really done. And if the break comes with heavy volume, wide candles, aggressive selling, that's the most violent version. Supply is still present. If you trade crypto or anything with thin order books, you'll see this aggressive version more often. Thinner liquidity means sharper moves. It serves the same function, just uglier. But it requires patience. Wait for a clear retest before committing. The quality of the trap tells you everything about what happens next. Low volume means the path is clear. High volume means you need patience. But in either case, the trap isn't the bottom. It's the last test. What follows is the proof, so the trap works. But why? What's actually happening beneath the surface? Let's talk about the plumbing. When price sits at a clear floor for a while, something accumulates below it. Stop-loss orders. Traders who bought the range place their stops just under the lows. Short sellers place their entries there too. Here's the key mechanic. A stop-loss order becomes a market order once the stop price is triggered. The SEC describes this explicitly, and in futures, research using CME data shows that these stops aren't even visible in the order book. They only appear when they're hit. So when price breaks below that floor, all those hidden stops fire at once. A wave of forced selling hits the market. And in fast markets, this creates what researchers at the New York Fed have documented as self-reinforcing price cascades. The selling feeds on itself briefly, but here's why it reverses. That selling isn't driven by conviction. It's mechanical, stops triggering automatically. Once the stops are cleared, the forced selling stops too. And the traders who got stopped out, many of them become buyers again later, re-entering, covering shorts. The trap creates its own fuel for the reversal. In Forex and indices, there's a time-based variant, a false move around the London or New York session open. In crypto, where markets run 24/7 without clear sessions, this timing filter is less relevant. But the structure is the same: break, reclaim, displacement. The point is, the trap isn't mysterious. It has real mechanics. And understanding those mechanics makes you more confident in reading it. So the trap happened. Forced selling was absorbed. But here's the question: how do you know the market actually passed the test? You need proof. And that proof comes from structure. After the trap, you're looking for one thing: price breaks above the most recent meaningful lower high, the last pivot where sellers had control. And it does so with displacement, not a slow grind. A strong, impulsive move that decisively breaks through. In smart money language, this is what they call a market structure shift. It's a useful term. It tells you in one phrase that the character of the market has changed from bearish to bullish. That displacement is important. It's not just showing buying pressure. It's showing that supply at that level has been overcome. And it often leaves behind an imbalance, a gap in price where the move was so fast it skipped right through. That gap becomes relevant later for your entry. For a more conservative approach, you can wait until price breaks above the entire range, above the high of the initial bounce. That's a broader confirmation, but also a stronger one. The concept is straightforward. After the trap clears the last sellers, there's simply no supply left below the range. When buyers push, there's nothing resisting them. And that's why the move is impulsive. Displacement isn't about exceptionally strong buying. It's about the complete absence of selling. The path of least resistance has shifted, and once that proof arrives, you have your green light. Now comes the part you've been waiting for, exactly where to enter. This is where everything comes together. You've seen the market absorb the selling. The trap fired and price snapped back. Structure shifted with displacement. Now, where exactly do you enter? The key principle is, don't chase. After that impulsive move that proved the reversal, price often comes back to retrace. Not always, but often enough that waiting is usually the smarter play. And that retrace is your opportunity. If it doesn't retrace, that's a trade you skip. Better to miss one than to chase one. You're looking for price to pull back into one of two zones created by the displacement move. The first is the order block, the consolidation zone right before the impulsive move launched. This is where the buying pressure originated, and it often acts as support when price returns to it. The second is the fair value gap, that imbalance we talked about, the gap left behind when price moved so fast it skipped through levels. Price tends to return to fill that gap before continuing. So you need three things to line up. First, confirmation. The trap happened, structure shifted, that's your context. Second, location. Price has retraced into the order block or the fair value gap. That's your where. Third, a trigger. Inside that zone, you want to see a clear rejection. An engulfing candle that closes back above the zone midpoint, or a hammer showing strong rejection of lower prices. That's your when. For your stop, place it below the zone or below the trap low for a wider approach. If price slices through your zone and can't hold it, the premise is wrong, and it's better to accept that early. When these three conditions align, confirmation, location, trigger, that's your engineered entry, not a guess, not a chase, a setup where everything in the chain supports your decision. Throughout this whole sequence, there's been one element running through every stage: volume. Let's connect the dots. Remember that first heavy selling, the panic that got absorbed? That was high volume. That volume spike is your starting reference. Then the retest, same area, but crucially less volume. That contrast matters. It tells you sellers tried again and barely showed up. Through the sideways phase, volume tends to contract. Less activity, narrower ranges. This isn't the market dying. It's supply being quietly removed, trade by trade. Then comes the trap, and this is where volume becomes your most powerful diagnostic. A trap on low volume? That's your highest quality signal. The sellers are gone. There's nothing left to sell. A trap on high volume? Proceed with caution. Supply is still present. Wait for the retest. And after the trap, when structure shifts and price starts advancing, you want to see volume expanding on the moves up and contracting on the pullbacks. That's demand and control, each rally confirming the reversal. This all comes down to one principle: effort versus result. Volume is effort. Price movement is result. When heavy effort produces little movement in one direction, it means the opposite side is absorbing it. When light effort produces big movement, the path of least resistance has been found. One important note if you trade crypto: volume data isn't always clean. Wash trading and exchange-specific activity can inflate the numbers. Focus on relative changes. Is volume increasing or decreasing compared to the previous stage? Rather than absolute numbers. Volume is the thread. It ties every stage together. And when you learn to read it across the whole sequence, you're not just seeing a pattern, you're reading the market's intent. Now, I'd be doing you a disservice if I made this sound like it works every time. It doesn't. So let's talk about when the chain breaks. The most important failure signal: the trap doesn't reclaim quickly. If price breaks below the floor and stays there, doesn't snap back into the range, that's not a trap. That's a real breakdown. Those stop-loss cascades we talked about can become self-reinforcing. A break below the lows can be the start of continuation, not reversal. That's why you always need two things: a reclaim back into the range, plus a structural shift. Just broke the low is not enough. Second failure: the entry zone doesn't hold. Price retraces into the order block or fair value gap and slices right through. When this happens, what was support becomes resistance. It's actually useful information. It tells you cleanly that your thesis is wrong. And let's be honest about the numbers. Setups built on this kind of logic show win rates around 59 to 65%. That means roughly 4 in 10 will fail. That's just the nature of markets, which means position sizing matters. Even with a 60% edge, if you're oversized, a string of losses can take you out before the edge has time to play out. Knowing when to walk away is just as valuable as knowing when to take the trade. All right, let's bring it all together. A real bottom isn't a guess. It's a chain of evidence. First, selling exhausts itself. Heavy volume, but price stops dropping. Someone is absorbing the panic. The market retests that area with less energy, confirming the sellers are done. Then comes the final trap. Price breaks below the floor, triggers forced selling, and snaps back. The quality of that trap tells you how to proceed. Structure shifts. Price breaks the downtrend from the inside with displacement. Your entry is engineered. Retrace into the order block or fair value gap with a clear trigger candle. And volume confirms every step. Heavy at the start, lighter on retests, diagnostic at the trap, strong on the advance. If any link in that chain is missing, you wait. If the trap doesn't reclaim, you walk away. If structure doesn't shift, there is no trade. And remember, always start with the higher time frame to confirm you're in the right zone. That's everything I promised at the beginning, the full sequence, step by step, so you can apply it the next time you see a potential bottom forming. If this was helpful, subscribe for more, and I'll see you in the next one.